The Aquest Podcast, Funds Industry Conversations.
Hello, podcast listeners, and welcome to the Aquest Podcast with me, Danny Lawler. If you're new to the Aquest Podcast, do hit like and subscribe, and feel free to share and send it out into the world as well. On this episode, I'm joined by Adrian Mulryan, who's the CEO of Invesco Investment Management. Now, Adrian was a guest before on the Aquest Podcast in 2018, and as you hear from the start of the podcast, he made some predictions in 2018 that have proven to be pretty close to the mark, and he's not shy about telling us that either, but fair play to him. So in this episode, our conversation focuses mostly around ETFs, but we do delve into a fairly in-depth conversation on ESG as well, and particularly ESG ETF products, if that's not a bit of a mouthful, and the flows that their business are seeing into ETF ESG products. We also chat about innovations in product development in ETFs, what we're seeing in terms of trends of flows and market flows and product types. And we also even managed to get into the world of tokenization and digital assets and how that might impact on ETFs into the future. Lots of ground to cover, so sit back and enjoy this episode of the Aquest Podcast.
The Aquest Podcast, Funds Industry Conversations.
Adrian, welcome back to the show. It's been a little while since we've had you on, and you're telling me that all your predictions from 2018 have come through.
Yeah, it was 2018 when I was on episode 10 of the podcast, and it was a run through ETFs in terms of how I saw it and where the world was at. And I listened back to that podcast in advance of today, and it's interesting because had a senior board member or director of an active asset manager been listening to that podcast, I essentially laid out what the playbook should be for the next couple of years in terms of right-sizing businesses, because I forecast we would see falling margins. I forecast we would see a move to passives from active. And what I also said is that the issue with having an ETF business is not necessarily about having a gangbusters passive offering. It's about learning how ETF businesses have scaled themselves, how they have reduced footprint in terms of people. They have excellent process. And if you can map that across to an active business, you can reduce your costs, you can improve your governance, you can better serve your clients, and you will insulate your margin as your product mix is changing.
And so it has proven to be.
And so it has proven to be, but for a lot of the asset management community, it's not necessarily something people want to hear, because the investment it takes to kind of fully build a better mousetrap, when you're looking at a short-term career horizon, some people may say, if I do nothing else, if I just sit here with a $70 billion business between market moves and everything else, and inflation, I will probably have at least 70 billion in a few years' time, and there's no real upside to trying to break the model. But for those who have, it's interesting because you can see there's certainly a change, and we're also seeing a change from when we had that in 2018. The growth and accelerated growth of private assets and private markets has been very interesting to watch. And that is now the play. So when you look forward, you're looking at managed account solutions, you are looking at passives, including ETFs, and you're looking at private markets and private credit as being real drivers for our business.
And does that then leave your regular equity active manager out in the cold?
Absolutely not. And active is an incredibly important part of our industry, and active products are a very important part of a properly structured blended portfolio. I always look at client assets as being on an allocation basis. And we used to always kind of say, look, managers would have allocations into UCITS and non-UCITS back in the day, or commodities or whatever else. It is exactly the same when it comes to managers now looking at how they allocate across the piece. Some is in exchange traded funds. A lot is in active, some is in sophisticated managed accounts at very low basis points for a sovereign wealth fund or something else. So it's about having that mix. And it's also about having a very kind of competitive offering where you have everything on the shelf and you allow your client in a self-directed way to find what the mix of product suits their strategy and their goals best.
Right. I'm gonna put a pin in that for the pearls of wisdom to revisit in 2028 or 2029 and see how we get on with this podcast and how things play out. But I guess we're going to focus our conversation mostly around ETFs. And I guess to start with maybe the market trends generally and how they have been and how they are looking into the future, particularly in terms of, say, assets under management and the size of the industry, and then maybe we'll get into the product type and how the product type is changing over the period.
Yeah, and I'm going to come at this with with obviously a European EMEA lens. But when you look at where we've gone over the last number of years, and we always talked about Europe being about a decade behind the States, and we talked about the hockey stick. And still within industry, there's this idea that ETFs are still relatively new. The first ETF was launched 34 years ago. So it's not necessarily that it's a new technology, but the move to passives, the move towards there's two things that have happened for clients. They've looked for, on one end, a search for yield, and on the other end, they've realized that fees compound the same way as returns do. So they're looking for kind of benchmark, passive, cheap access to content. And I'll give an example of Ireland. So Ireland has about 70% of the European ETF AUM. In 2011, for the first time, it hopped over 100 billion. It was 102 billion in 2011. By 2019, it had got to 605 billion. Last year, 2022, it actually went through a trillion for the first time. And in 2023, we ended up plus or minus about 1.8 trillion at the end of 23. So we've seen phenomenal growth over that period, and growth that has come from broad-based passive product. There hasn't necessarily been a sort of a kind of a product set where you say, okay, smart beta has been a winner here, it's knocked it out of the park. It's been following the line of people like using ETFs to access the likes of the S&P or the FTSE 100 or similar. I think SPY in the States is now over 500 billion in AUM. So in a single product, that's huge, but it just goes to show how people have been using ETFs as a core part, a building block of their portfolios. And that will not change, in my view, over the next number of years.
And is the money coming from, is it new money, or is it money that's been pulled out of something else to be invested into an ETF?
That is interesting. So again, assets in our business tend to be quite sticky, particularly when you look at the sort of the more retail side as opposed to institutional side. But there was a study done a few years ago where somebody looked at various market crises as they had hit from the GFC. And every time you saw a material outflow, as people went liquid and went to cash, that cash always came back in again, but it tended to come back disproportionately into ETFs. So you tend to see that as being something, is that people aren't necessarily liquidating positions to move in, but the retail story is huge, particularly in the US, but it's starting to garner now in Europe. And like for a sophisticated sovereign wealth fund, they can go to any manager and get a managed account as cheap as they like. But I think people are starting to see the ETFs as that core part of their portfolio, that core offering, which is really helping the narrative. And also, I think European product travels well between the South America and the core markets there, and Asia, of course, which has always been a keen user of UCITS. And as much as the ETF is a wrapper, the UCITS is a brand, and it's been a huge success for Europe on the global stage, not just in the European Union.
Absolutely, and you will know if you ever sit around a table with, well, regulators or other professionals from across the world. I don't know that there's another brand like UCITS that you can just mention and it's from one region and everybody around the table knows what you're talking about. So, you know, it's testament to how good a product it has been in terms of the controls and safety net that it brings for retail investors. And then you overlay your ETF onto it, and you've got something that people can understand very easily, regardless of where they are in the world, more or less.
Yeah, and in the run up to the GFC, I think we had our dalliance with UCITS and kind of more aggressive. I think UCITS has now gone back to what was originally intended, and it is very much seen as you can use UCITS interchangeably for diversified, well-structured content.
And so on the product side, obviously, so we see the flows and we still talk a lot about passive. What are you seeing there as being the emerging trends? Is it still passive index tracking? Is it different types of indices? Is it more intelligent and, you know, non-market cap indices? We know thematics have become more popular. And then, of course, the evergreen topic of active ETF. So across all of that, where is the most interest been and where are the exciting developments?
I think the exciting developments are very much interest rates are back. So fixed income is back. And we're certainly seeing that as being a growth in product set and a growth in opportunities for most of the sophisticated managers in this space. Thematics are great, and they're great from a marketing and distribution perspective, but they don't tend to necessarily knock it out of the park in terms of the AUM they garner over time. It is great to have an access product to a particular asset class or market, but it doesn't necessarily become a benchmark. I think in the European context, one of the most interesting things has been ESG and the client appetite for ESG, because it's been interesting for me looking at it. You have push and pull factors. You have kind of the SFDR and the regulatory framework setting out how you need to categorize your product. And at an event earlier this week, the central bank were mentioning that 1/3 of their products is Article 6 and 2/3 is now Article 8 and 9 in terms of their new approvals. And within my world, sitting within Invesco in Ireland, what was of note to me is that a lot of our content we're building at the minute very much has an ESG focus because it's what our clients want. And the reason we understand that is that our book of business in Ireland has about 8 to 10% is in ESG content, Article 8 and 9. But last year, 30% of net new assets or 30% of flows was into ESG content. That is the client driving the agenda around what product they want and what they want to see built. And that will be a driver for the next while in terms of how people look at the exposures they offer to clients.
And is that a short-term trend, a short-term fashion, or do you think this is here to stay?
It's very much here to stay. And it's twofold in that, because it's not in terms of is ESG fashionable. We don't want to ever get into a realm of people just pushing out green content for the sake of. I think there's two things happening. I think actually corporates themselves were much further ahead on the green agenda than perhaps the asset managers and the content that they were providing. So I think we are seeing ourselves going into a new phase for corporates, but then we're also into a new phase for the content itself, how it's structured, the outcomes that it's seeking to achieve. And again, content providers merely want to reflect the needs of their clients. So this is not necessarily a case of we are not trying to, inverted commas, push ESG content. ESG content is being bought from us and we will supply it on that basis. But we very much follow our clients in terms of where they think the returns are, where they think their own needs and desires and wants are vis-a-vis ESG concerns.
Yeah, and I guess that's a great place to be if you're looking at trying to manage climate change and looking to improve sustainability. If it is the market and the investors that are driving that demand, then certainly it'll be up to providers to satisfy it. But as opposed to providers trying to create a product that there maybe isn't really an appetite for.
Exactly.
And I wonder, obviously, Europe seems to be, I guess, towards the forefront of ESG investing. The States has its own approach to it. But, we talk about ETFs and UCITS ETFs being well known across the globe. Have you a sense for how other jurisdictions treat or fancy ESG investing?
I think everyone is looking for access and exposure to well-constructed ESG content. I think that's partly driven. Again, there is a full continuum from every country in terms of where they are on their journey, whether they think it is important or not, but it is very much something that has to be on the shelf. But it's something that is on the shelf to be pulled, not content which must be pushed. And I think that's the driver. And you'll see peaks and troughs, and you'll see spikes in appetite from locations, depending on what's going on in their environment, what the actual discussion is in that location at a particular point in time. But I'm interesting to see for me, because we do break the stats down kind of across kind of jurisdictional and client types. And there are definitely trends emerging. There is definitely areas that are ahead of the curve, and there are areas that are picking up onto ESG as a thematic. But part of this will be driven as well as there will be a bit of a look back factor, and people will be focused on performance as well. People do actually need to generate returns, and managers of pension funds or otherwise have fiduciary duties to their end investors as well. So it's about trying to find that mix and that blend and ensure that all the interests of their stakeholders and investors are looked after.
No, absolutely. And I wonder if there is a price or a cost that investors are willing to pay for sustainability, but that whether there's a set amount for that in the way similar, that you might be willing to go with one airline as opposed to another and pay a little bit more if there's an element of that to ESG investing. So I guess it's important that the performance is going to match.
Well, but what's more interesting for me is the data is getting better. And that's actually the point. And part of what SFDR and other initiatives have done is to actually get people to focus on data and get people to focus on reporting. And that gives people clarity in terms of what they're actually seeking to achieve and how they're seeking to drive it. And what's interesting for me is that particularly when you had the Article 8, Article 9 Paris Line benchmarks issue last year, where a number of the Article 9 benchmarks stepped back to Article 8 until there was more regulatory certainty and clarity around how they looked at their categorization. That didn't change the mindset of the clients. The clients are actually, the sophisticated clients are actually able to cut the data themselves. They know exactly what is under the hood of an Article 9 fund or an Article 9 that has stepped back to Article 8, and they will continue to buy that because they know what it's seeking to achieve. So the clients are getting sophisticated as well, which is heartening because they are actually looking at the data. They're no longer just passive and reliant on what a manager may be telling them. They are actually ensuring they understand for their investors what's going on under the hood.
And I wonder then, Adrian, if you have a sense for if the SFDR is under review at the moment by the Commission, and obviously it's not around very long, so it's quite early days to undertake that kind of an analysis. But if they were to come back and change it quite significantly and change the approach and the approach to naming conventions and stuff like that, do you think that what impact do you think that would have on investors? Would they, accept that it's a refinement, or would they think that they just throw their hat at it because it's been, it's just a bit too confused and changes too much and too unsettled?
Interesting. So 2 points on that. I am glass half full when it comes to SFDR. I don't think we would have necessarily started with SFDR given our experience a few years down the line in terms of what we were seeking to achieve, what the data actually did, and how it was actually useful for clients to articulate what types of products that they should be buying. Now that we are some time in, I think obviously a relook at it is important, a recut of it is important. But what's more interesting for me is the data that is coming down the line. So CSRD, the Corporate Sustainability Reporting Directive, is actually going to provide an awful lot of clarity for companies, which is going to provide clearer data, which is going to provide better metrics for categorizing the sustainable nature of underlyings, which will then in turn drive how we look at the overall reporting. And that is the piece that's interesting for me. It does need to change. There does need to be a reassessment in terms of how it works and what the value is it derives, because ultimately what I would like from it is not that I understand it, that an end client understands it. That an end client says, I am buying that product because it is in X category, and I intuitively know what that means for me and my value decision or my investment choice.
Well, it was more of an ESG conversation than I was planning. So let's jump on. I just want to talk about active ETFs for a moment. So, it's been something that's been talked about for a long time, and, speculators to the extent that the existing range of active funds might try and ETF themselves. But at the EY event this week, I was really interested to hear that is happening, but that firms are living with transparency. So one of the kind of the roadblocks to active ETFs was presumed to be the idea that you'd have to disclose all of your portfolio every day. And in the US, they have a semi-transparent ETF, an approach to try and balance disclosure versus, allowing these products access to market. But there does seem to be a drive now where some managers are happy to just disclose and run their ETF with full transparency over their portfolio. Is that something you've seen? Is it something that's going to continue? Is that how active ETFs get to market, or is it still only going to be for a very small sector of the ETF market?
Very interesting to talk about this in the context of our last conversation in 2018, because we very much spoke about what would happen with active product. And at the time, what I said is, look, an ETF is just a wrapper. It's not a killer application, but it does have certain attributes. The attributes are transparency, liquidity, and price. And they combined tend to make ETFs attractive for investors. What you're seeing from my perspective, with the move to active and active ETFs is that you could never have a non-transparent ETF because the market makers need the information in order to make a market at tight price on exchange. So you would always be in a realm that you would have semi to very transparent or transparent inactive for it to work. What we're seeing in the States is a lot, and the growth is in the States. I think flows to active last year were 184 billion in the US. in Europe, it was just 7 billion into active content. And that tells you two things. One of which is the US is further along on its journey and ahead on the curve. Yes. The second thing is what a lot of US managers have been doing is they've been taking content, which is essentially not aggressively active in broad-based listed securities and moving that into an ETF wrapper. And that is partly to increase their ETF shelf, increase their ETF offering, launch ETF content, which is seeded with a very large initial transaction because they're converting, and it brings them into the ETF space. It brings them into the passive flows. It gives them a better story at a quicker pace. And that makes perfect sense. But this idea that we are going to suddenly have this sort of a rush to non-transparent or aggressively structured content being put into ETF wrappers because ETFs sell, I don't see that side of it happening. So it's interesting to look at flows, but also to look at motivation and also to look at the type of content which is in the active space. It is active light in my book, and it is great to see because, again, it's a wrapper. And the ETF is important because it allows people to trade like a stock and then also bring the tax benefits that ETF wrappers have from a US perspective.
Yes, so I'm going to mark that one down for our next podcast in a few years' time and see how that plays out. But I suspect you're pretty much on the mark for that one. In terms of other innovations then, so outside of product type, maybe more operational innovations that have come or are coming, is there anything that ETF providers are doing differently or that new ETF providers are going to do to try and gain an advantage or offer something to clients that isn't there at the moment?
Again, the things that differ from the ETF business to the traditional mutual fund business is distribution. ETFs have always sold well in differentiated channels from traditional mutuals. ETFs have embraced platforms. And we are seeing, and again, we saw post RDR, we discussed this last time, post RDR in the UK, the aggregation, amalgamation of many small investment advisors in the UK into larger groupings, which are more sophisticated, have better risk controls, have better value metrics for end investors, and they tend to lean towards ETFs as being part of their core portfolio. Those platforms are getting more digitally focused in terms of their distribution, and the ETFs sit very well within those platforms because of the nature in terms of how they price intraday and how they trade and how they settle. So ETFs are a net winner, I think, of the advisory channels in Europe getting aggregating into larger pools. And I think when we look to the European policy agenda over the next few years to get citizens in Europe focused on saving for retirement, I think the ETFs have a very good part to play in that. It's only part of the story. There are other products available, but in terms of having a low-cost core exposure part of a retirement portfolio, they've got a very important part to play.
Which brings on nicely because you mentioned the European agenda. In terms of the regulatory agenda for ETFs, I guess when we spoke the last time, ETFs were definitely something that regulators were interested in, especially in Ireland because of the size of the marketplace compared to the overall amount of funds regulated here. Last year, we saw IOSCO publish some good practices, but they essentially, stand by their 2013 recommendations for ETFs. It's not on the work agenda for ESMA this year or the FSB. So do we get comfort from that regulators have had their look and they're happy with the structure and organization and operation of ETFs, that they're happy, haven't been through a rocky period through COVID in terms of, things could have gone wrong, but they structurally, they look pretty sound. They've stood up to the vulnerabilities that could have been there otherwise.
Yeah, that's interesting because, again, ETF providers have a very open and transparent relationship with regulators. I think that's one thing we've been very good at, is going in, and whether it's the discussion on synthetic content or discussion on how we look at active, we've always been very open. We've gone in and saying, look, here's where we think things are going to work well. Here's where we think the challenges are. What do you think? As a result, I think regulators have become more comfortable with the idea of the fundamental underlying nature of these products and of their liquidity. And I don't think there are significant risks are fragilities that are out there in the context of ETFs in terms of them being a systemic risk, and we're certainly seeing that kind of playing through in discussions and engagements that are had at the regulatory level. What's always there is a discussion between, well, where does ETFs begin and ETPs end in the context of distribution? That's always a point. And another important point is now that there's been a final agreement between the United Kingdom and the EU post Brexit, is how do we ensure that we keep in step in terms of with the FCA's view of the world and with Europe's view of the world, because they are very similar in terms of how we need to look at product, how we need to look at risks, how we need to look at content, and ensuring there's an open and broad dialogue there across the EU and the UK as it sits as a third country.
Yeah, I think you're right, and I think that the work that the regulators have done and the input that the ETF industry has been able to give them has been very useful, and I think it has given comfort about the structural soundness of the ETF wrapper. I think, given the growth and the size of it, I think it's bound to come back on the agenda at some point, simply because of the AUM in there and the fact that if there was an issue, it's going to be magnified by the amount of assets that are in the ETF product. So I think it's inevitable that it will come back to the agenda. But I think for the moment, the work done so far, I think, has given regulators and industry comfort. But down tools.
Exactly. And as I say, that's not to say that we won't have our challenges. And I think it's been really interesting, particularly in the Irish context. The central bank have done a really good job over the last kind of couple of years of managing crises, that when a crisis arises, they are out talking to all the key stakeholders in the market to say, okay, what are you seeing? How's the market reacting? What do you think we need to be thinking about? What are you thinking about, and how you're managing your risks? And that sort of open and constructive dialogue is really important in terms of how you look at macro issues that impact asset classes that may have a knock-on effect for ETF promoters and ETF platforms.
Absolutely. A very key part of that supervisory process is that engagement. So just before we wrap up, Adrian, last question for you, and I'm sure this is one you're going to love. It's just about tokenization. And I know there was I said we were together at an event earlier this week, and there was a question about tokenization of ETFs. What's your take on tokenization of ETFs, Adrian? Are you banking on it?
Interesting one, because as Hector McNeil made the point that he thought, well, the ETF was essentially a token anyway. So, and what I think is happening here is digital assets is something that is just being put out there, and actually it is much more nuanced. Digital assets covers two things. It covers everything from tokenization to distributed ledger technology to crypto and all things in between. I think the focus for the next couple of years in our industry is going to be digital assets in the context of infrastructure, in the context of how do we actually take out cost for end investors, and how do we actually improve settlement and settlement cycles. And fundamentally, it's the operational piece people often miss in the context of funds. Cash settles at a different time to market close. Funds have cutoffs at a different time. And working through all of that, having an instrument that can settle live in real time is something which is a focus point for people. And I think we will see it first in money market funds as opposed to ETFs, because they are the most cash-like instrument, and they actually have a lot of settlement challenges which are there for them. So that's the piece to me that's most interesting is, yes, tokenization, but what does tokenization mean? It means taking out layers between a fund buying an investment and an end investor buying an instrument on exchange and having it delivered to their custody account. You could have 7, 8, 9 different transactions in that flow in that process. So will tokenization bring some of that into a simpler process? Can I, Adrian Mulryan, have a digital wallet where my ETF goes straight from promoter into my digital wallet? How would that look and feel? They're the types of issues that I see, but there's certainly opportunity there, because we are still running a lot of our industry on legacy infrastructure, and at some point there will be the ability to try and manage out some of that and run through some of that, and that will actually help drag it back to the regulatory point. The FSB and IOSCO last year looked very closely at liquidity mismatch in funds, and I'd be curious to see what this type of digital asset transformation will do for how we look at liquidity and how we look at the ability to settle transactions and lay off risk in the broader context of the fund sector, not something which is an issue in the context of ETFs.
Yeah, I think you're right. I think the use of technology in making operations more efficient is very interesting and probably a very ripe area for, as you said, an industry that relies on legacy technology, but not an easy one to do. I think in terms of tokenization, like the ETF is, as you said, it's an index that's being unitized and is available to transfer quite freely and quickly. So maybe an ETF tokenization isn't the obvious one to go for. Maybe it's maybe more liquid assets are more obvious to tokenize and unitize. Anyway.
Well, no, just on that, there was an example of in one jurisdiction where a forest was tokenized and it made the trees readily tradable in the context of carbon and other uses. And that was just an interesting case. And you can do the same with solar panels and solar farms. And as you say, it will lend itself. There was lots of use cases for tokenization in the context of the more illiquid space. And there's lots of opportunity for tokenization in the context of how do you actually deconstruct some of the layers we have within industry. But as you say, it's not a baby and bathwater situation. It is something which is going to evolve over time. And I do think the regulators are actually getting in front of this. They are starting to ask the right questions in terms of what is digital assets in the context of our industry? What is it in terms of the future direction of fund promoters? And what does it mean for our clients?
Well, on that note, Adrian, let's wrap it up. I'm going to see when we meet again in a couple of years' time if you'll be able to crow about your correct predictions as you were at the start of this podcast. So let's hope so.
Great. Thanks, Danny. Cheers.
Thanks for your time, Adrian.
Okay.
The Aquest Podcast, Funds Industry Conversations.